Dear clients, over the past year, one of the strongest performing equity markets in the world has been South Korea. Yet, interestingly, despite this strong performance, Korean equities are still trading at valuations that are significantly lower than most developed markets. This creates an interesting situation for investors. A market with strong earnings momentum, yet still relatively inexpensive. Let's start with the fundamentals. The Korean market, represented by KOSPI, currently trades at roughly 10 to 12 times forward earnings. If we compare that with the United States market, where valuations are often 20 times forward earnings, Korean equities are still priced at almost half the valuation of the US market. Historically, South Korea has always traded at lower valuation due to what investors call the Korean discount. This discount existed because of corporate governance concerns, complicated ownership structures, and relatively low shareholder returns. However, in recent years, the Korean government has started implementing reforms to improve corporate governance and encourage companies to increase dividends and share buybacks. These reforms are aimed at narrowing this valuation gap. At the same time, South Korea sits right at the center of one of the most powerful investment themes today, the global demand for artificial intelligence and advanced semiconductors. Two of the largest and most important companies in this space are Samsung and SK Hynix. Both companies are global leaders in memory chips and high bandwidth memory used in AI servers and data centers. As the demand for artificial intelligence continues to grow globally, these companies stand to benefit directly. Because these companies make up a large portion of the Korean equity market, the growth in the semiconductor cycle translates into stronger earnings growth for the broader Korean market as well. For clients who wish to gain exposure to this opportunity without having to select individual stocks, one convenient way is through an exchange-traded fund. One example is the iShares MSCI Korean ETF, which provides a diversified exposure to most of the largest and most important Korean companies across sectors such as technology, financial industries, and consumer businesses. What makes the situation particularly interesting today is that despite the positive long-term outlook, the ETF has fallen by almost 20% from its 52-week high, primarily due to the current Iran-US conflict. In investing, it is often during these periods of temporal price weakness that long-term opportunities appear. Markets rarely move in straight line. Even in strong long-term trends, short-term corrections are normal. These corrections allow investors to accumulate positions at more attractive prices. When we combine several factors together, a market that still trades at relatively low valuation, strong earnings growth driven by global semiconductor cycles, structural reforms aimed at improving shareholder returns, and a recent price pullback of about 20% from its high, we begin to see why Korea is starting to attract renewed interest from global investors. Of course, every investment must be considered within the context of a well-diversified portfolio. But for clients who are looking for exposure to global growth themes while still maintaining a reasonable valuation, Korean equities represent a compelling opportunity worth considering. If you'd like to explore how exposure to the Korean market may fit into your overall investment portfolio, feel free to reach out to me and we can review the possibilities together.